Welcome to the Salty Investors, the first Salty Investors podcast for 2023. I'm psyched. How about you, Tim?
Oh, definitely psyched as well.
Psyched. Yeah, I bet you that market rally's got you psyched.
Oh, yeah.
Um, in the new year, always good to get you psyched after that. Let's have it. Give it to me, Tim. What's your salt? What's your
Well,
salt
like
for this week?
inflation's still fairly extreme. And
Mm,
I just saw it uptick in Australia. We saw it, 6.9. Now it's over 7 again. And
yep.
um, last month it decreased and the market rallied. This time it increased and the market rallied. So
Yep.
I don't know what's going on here, but someone's not getting this right. Someone's looking through,
Bad
or
news is good news, and good news is good news.
yeah, and I don't think people have understand, it needs to be seriously bad news before the market, the Feds and the RBA is going to pivot, not just, oh yeah, it's gone up, a couple of points
It's all
here.
priced in, Tim. It's all priced in.
Yeah, so I'm just, what's everyone thinking here? I can't really understand it at the moment, so that's got me a little bit salty. What about yourself?
My salt this week is sort of recurring salt, if you like, because we've spoken about this before, and it is your fault. I mean, you triggered me with an email that you sent about this company called Sigma. And Sigma claimed that 4 out of 5 private investors want to invest with a positive impact on the climate,
Mm,
according to them. So they've basically got a whole dashboard now with 1,500 stocks and their climate scores, So, and it just you can see where this is going. This is basically going to be a social credit system. Companies are going to be ostracized for not getting their scores
yeah.
in line. But as we've said before, it's a total mess because if you want to think about what's detrimental to society, Coke, Pepsi, these are darlings. They're fine.
Mm-hmm.
And so there's one or two things got to happen. They've got to get more and more strict with this and start
Yep.
saying, yeah, we can't have Coke in there because it causes diabetes or whatever and costs the health system billions of dollars. Or you just be a complete hypocrite and don't do that because and you just sort of single out, because I mean, once you go down this track, you say, okay, things that are bad for the climate. Well, okay, what about things that are just bad for humans in general, like unhealthy snack companies, for
Mm-hmm.
example?
Yep.
What does Mondelez
Oh, yeah.
make that's actually good for you? Anything? They probably have some bottled water or something. I don't know.
Yeah, expensive
Um,
bottled water. Yeah.
yeah, yeah, overpriced bottled water. But yeah, it just where does it end? I don't know. It seems to me a bit of a dead end. And at the end of the day, I mean, why are you investing again? Why are you investing again? I thought it was to get returns. And if those returns come from something like drilling oil, I don't really give a shit. And I suspect that if people have a few years of shitty returns,
Oh,
they
yeah.
won't care either.
It'll change, but yeah, we'll have
But
to
maybe
wait and
I'm
see.
just on the wrong. I'm a dinosaur, Tim. I'm on the wrong side of history. This is the new wave of ethical investing, and yeah,
Well, I
I'm
keep
just
getting told it's got proven returns, superior returns to non-ESG
that,
companies.
and
So
yeah, and that's nonsense. Yeah,
yeah,
that is provable nonsense. Yeah, I mean, last year just proved it to be nonsense. I mean, wasn't the resource sector the only sector that was up in
yeah,
the
50,
US?
or energy 50% up. If you didn't have any of that in
Yeah,
your portfolio, you're stuffed. Like you
mm,
were down. Doesn't matter what
yeah,
else you're into. But, mm.
yeah. Yeah, so yeah, that's enough of that salty stuff. But let's move on to some current macro stuff. Plenty to get into, namely. Now, I want to bring this up first before we talked about retail sales because I thought this was interesting. This came out on the 30th. Where was it? Yeah, 30th, Friday the 30th. So this was the last trading day of the year, I think.
Wow.
Um, and they came out and said that unprecedented growth Boxing Day of sales was awesome. Now, if you've been listening to the Salty Investors for the last 3 months, we've been saying Christmas was going to be fine, it was going to be good, people were going to spend up, and it's the hangover that's going to be the problem.
Mm-hmm.
Now, but I think that it's the Australian Retail Association, they've got a vested interest in
Yep.
pushing a positive narrative, no doubt about it. But they've got basically 3 periods here. They're talking about Boxing Day, they're talking about the lead up to Christmas, and then from sort of the Christmas period, which is November right through to Boxing Day.
Mhm.
And they said that the pre-Christmas splurge was up 8.6% on last year. Okay, well, that's great. It's a record
Mhm.
number. Dig into it a bit. So these are as you can see there, the Boxing Day, just Boxing Day numbers. Then the 1st of December to 26th, and then 1st of November. So if you look at the 1st of November, total up 8.6%.
It's huge.
Now, all nominal numbers. Inflation has been about 7%. Now, it depends which category, of course, but these numbers aren't that great when you take into account inflation. I mean, inflation practically wipes out most of that, right? Like, it's really, in real terms, it was up about what, 1.5%,
Yep.
maybe. So cafes, restaurants, takeaway food are up nearly 20% compared to last year. Well, last year we still had lockdown restrictions in place in that period, so it's not as good. I mean, I'm glad that we've got rid of all that shit, and I'm glad that people are out spending, and you see loads of people down cafes near the beach and all this sort of stuff. It's great to see, but I think this is just a little bit of a beat up.
Yep.
I actually moved your inflation chart up a couple because, as you just said earlier, we had an over 7% print. Remember, the RBA said we could see 8%, and then the next month we got a print below 7. Oh, it's all over, and now we're back above 7 again. And so that was for November, and just these are the groups again. So you can reference some of these groups back to that earlier retail sales number and say, like food's up 9. Clothing and footwear 5. You've got furnishings, computer equipment 7. They don't match exactly the same categories, but so you just, those retail sales numbers, they're all right. It's an economy that's not in trouble, and people are doing okay for now. But I just thought that was worth putting in perspective, because I just picked out some discretionary retailers, and this is the moves they've had in 12 days. I'm pretty sure the last podcast that we did before the end of the year, I talked about what if retail, some retail stocks will absolutely go through the roof when the cycle turns and people believe interest rates are coming down. They've already had a run, and I don't know if this is a good time to sell some of these if you think that times are going to get tougher, because those retail sales numbers mean that results that are reported in February will be good for all of these retailers, right? I mean, I think pretty much. I mean, there are some of these guys here that have had issues, like most of the Kogan's had issues, for a little while, but I mean, Adair's hasn't really. It's been fine, and I mean, it's just took off 26% the last 12 days. Did you explain that to me? SUL is Super Retail Group, which is Super Cheap Auto, BCF, Rebel Sport, and something else I can't think of at the moment. Even Harvey Norman, I mean, it's a big stock, doesn't move. The volatility is not as big as the others, but 5% in 12 days, it's all right. 8% for JB. So, all of these have moved in anticipation that, hey, maybe things aren't that bad. Maybe the RBA is done. Although, given that last inflation print, you'd think the RBA is probably not done. But they do have another month to sit on their hands. They're not going to meet till Feb.
They should have done the 50
anyway.
when I said, like, if they did the 50 instead of these little 25s. But I don't know,
So I guess I've been talking for a bit too long. What do you think, Tim? Do you think that maybe retail has turned the corner, or would you want to dip your toe in there? Yeah.
Well, I know they probably haven't got too many more hikes in them, like the RBA.
No.
I'm not in that camp. I don't think they're going to be doing another 100 or something. So,
No.
But I can't see them pivoting unless things really go bad. So, remember, households are going to be forking out an extra $1,000 a month basically to pay for the mortgage. So
Well,
That's normally
that's
comes from
only if you,
discretionary, doesn't it? So,
yeah. Well, that's only if your mortgage, I think, is 500 grand. If you've got a bigger mortgage than 500 grand, it's going to be more than that, actually. I think
mm.
latest figures suggest. Yeah, because we're still playing catch up on that game.
Yeah, so
Some
that money's
people,
got to come from somewhere. Like, I don't
yeah.
see everybody getting a pay rise continually, you know.
Mm.
So that's yeah, and these places should be hit first. You'd think discretionary should be the hardest hit out of that.
Yeah, I suppose Lavisa is one. They've still got a big store rollout story going all across Europe. They're not just
Okay.
domestic focused. So I mean that's driven a lot of their growth. But I mean, pretty much everyone else there is. I mean, step one, which I've talked about before because I kind of like it, but they've had difficulty breaking into US and UK markets. They spent a lot on marketing over there, and their customer acquisition just didn't they just didn't pull it off.
Mm-hmm.
They couldn't get much traction. They got a bit, but not much.
Yep.
But yeah, the rest of them are pretty much domestic. Adairs is a little bit in New Zealand. Um, yeah, I mean Kogan's fully online.
Mm-hmm.
Um,
But they've got all the
yeah,
inventory as well. I've got all this inventory
yeah,
backlog as well. So I can't see why they're really rallying that hard. I can see it
mm.
short term, yes, but you know, middle next
Well, I think
this year.
I would say something like Adairs dipped below. You see, it went from 220 on the December, but it actually dipped below $2 briefly last year. Now at that point, Adairs was yielding over 8% dividend yield and was
Wow.
on a PE of about 9 at that
Hmm.
point. So yeah, unless and that's pretty damn cheap. I mean, but those, I mean, that's where those stocks trade when interest rates go up.
Yep.
But if we are sort of at the peak of the cycle, then maybe that's maybe that was a bargain. Full
Yes.
disclosure, I own some Adairs, and in the last dividend, I actually opted for the dividend reinvestment program and got some more shares
Oh,
instead, and I didn't.
nice. Oh, you'll be
Yeah.
doing good then. Yeah. Okay.
So I'm pretty happy with that. Yeah.
Nice.
Um, but
Yeah.
yeah, I don't know. It's a bit of a
Trim a little bit,
selfish
maybe.
question.
I don't know, but what do you
Yeah,
trim
that's
into?
what I. Yeah, exactly. You've got to have something to trim into. Um,
Hmm.
yeah, not sure. Anyway, that's I think that's a bit of interesting
Hmm.
macro stuff. We'll move on to this latest from Cliff Asness, who's one of my favorite blokes. He's a quant. He just sticks to the data. Love him.
Yep. I thought, yeah,
So
I know you'd like this. I saw this investing with Tom. He got like, wow, Tom, like he's reading some decent stuff nowadays. So I thought, wow, I've got to put this in here for you. I'm like, boy, how far away are we from an actual correction? Like, I know this is all doom and gloom, but wow, when you look at these numbers, the 94th percentile, like it's got a bit of room here.
But
So
just explain what this is first, because it's not clear.
yeah, this is
94th percentile.
his value spread type thing that he's looking at. Um,
Right.
so as you can see here, there's still a lot of froth in the market. You know, you can still see that things can correct a fair bit, and you can see it goes negative here as well from his
Yeah.
score for long periods of time here. So I don't know if he's over corrected this scale, but he says he's done some rework on it. Like he's not full time anymore, is he? I don't know if Cliff's full time. I don't know
Is
if
he?
he.
I don't know.
I don't think he's actually doing too much, but
Mm.
yeah, you can see he's looked at this in 2001, you know, and then he's redone it again for us.
Yep.
And you can see here sometimes where it's just got away from us here, really. Like,
Mm.
and what was I doing in 2014 and 16? You know, I should have been allocating more, you know,
Yeah.
but
Should have
yeah,
knew. Yeah.
so there's still a little bit of room in this. It's just one of these charts, you know, that you occasionally have a look at. So,
Yep. Yep. Always, Cliff is always worth a read,
mhm.
isn't he? All right. So you want to look at elevators? You've been bothering me about this one for a while. Take us through OTIS. There's probably people out there watching all 3 of them who've there's some kind of noise coming through the background there. You
Yeah,
got
there's
some
some
wind chimes or something?
mower
Oh,
or
right.
something I've got going on.
Oh, that's all right. Otis, yeah, they're into lifts. So people would have got into buildings and probably seen Otis lifts in their lifetime. What else is that? Is that the only thing they do, Tim?
Yeah, basically. But it's broke. It was just a spin-off of Raytheon. Them and Carrier, the air
Yep.
conditioner. They split them off for a spin-off. I really like the business because
Mm.
it's really stable. Like you're not going to change, elevators in your building, are you? Every look at that and go, oh, let's switch to Cone or someone else.
Yeah.
Basically, when you put it in there, you're stuck with them.
Yeah.
And the thing about Otis is it's not really the elevators where they make the money, it's the servicing.
Right.
So they're building products into their service line now that makes it hard for third parties to really service them as well as Otis. Like other people can still do it, but they've got digital integrations with it now, so they can sort of tell when elevators are sort of
Okay.
not going to be working so well, and they can come up and check them beforehand. So they've got like uptime increases.
Yeah.
So you got all these, and that can be built into a contract as well. So you can say, oh, we can sort of guarantee, 95% uptime or whatever. And the service company has to come out, they've got none of that technology to detect, how well the elevator's doing. They can put advertising and all this other stuff. So you look at the numbers here and it's just phenomenally good. Price to free cash flow, you don't normally see a 25 on something that's got return on invested capital above 40. There's only a couple of companies in the world that have got return on invested capitals above 40 consistently, and that's things like Visa and MasterCard. And we know how strong they are and how impossible it is to get away from those guys. The only thing here is the gross margins are a little bit low. That's because you've got two components. You've got the service component and also the install component. So it brings that down a little bit. So that's the only thing but they've got heaps of plans to expand into China. So there's heaps of room to grow here. The debt's obviously a little bit concerning. I haven't got that on there, but
well, what's their debt to equity or net debt to equity?
I don't know, but the currents are basically one. So current liabilities versus current. So it's nothing totally bad. They didn't load them up with all this
they're not
huge
leveraged to hell.
Yeah. So they're not so leveraged to hell, but we're going into a high interest rate environment, so there might be a little bit of a concern there. But you don't normally
got plenty of cash.
Yeah, they got plenty of cash. So short term cash, they're fine, and they're investing into China, and looks like they've got a runway there. So I think, but if the Chinese economy stalls a bit, which is a concern, I don't see the growth increasing. But you don't expect too much growth from this. This is sort of like one of those plays where
that's what I was. Yeah, that's what I was going to say. I mean, what is the global increase in large buildings around the world? I mean, what would it be? 3 or 4% a year or so? It's sort of that sort of business, right?
Yes.
Yeah.
So you're not going to be like, a huge multiple on this thing. You're not going to get multiple expansion on this thing at all. But you should be looking for something a little bit more conservative, but it's got, very nice fundamentals that are going to hold you through. This is the sort of thing I put my limit order in, and then obviously it's got away with me. The last month.
What did you put it in? 70 or something? Did you?
Yeah. Like I'm trying to be greedy here, and waiting for a downturn. Just a down tick. It wasn't even too much away, and you're hoping for this little bit of correction here, and then just keeps going away from you. And you're thinking, oh, I'm getting greedy, but that's just life, I suppose. But so now it's gone up a little bit from about 20 price to free cash flow to about 25. So still, it's a bargain. Like got a dividend as well paying you. So can't complain. What do you think? You think?
Yeah, I like it. I like it. To me, just based on what you said, which because you know it better than I do, but I like the sound of the business. I wouldn't have a problem investing in this. It just comes down to price. What do you pay for it?
Yeah,
that's basically it. Because as you said, I mean, this is not going to have 20% earnings growth for the next 10 years, is it? It's not that kind of company, but they're just going to incrementally keep growing. And so if you can get it when it's, I guess you just have a look at history and say, look, if it trades on 30 PE or, traditionally trades on 20 cash flow, then you can get it at 30, 25 or whatever, then, it's a good deal.
Yep.
And it'll outperform. Because I've got to get out of this mindset that I'm going to get a 5-bagger in the next 2 years or something, like if you get this at a good price and it gives you a 12% return over the next 10 years, as opposed to the market giving you 10, then it's a winner. That's the winner. And you should be looking at it like that. But of course I want the 20 bagger over the next 10 years,
Yeah. And the thing I like about it as well, like you can just set and forget this thing. Like 5 years time, there's people still going to be using elevators. I'm pretty sure 10 years.
No, they're going to be flying on their jetpacks, Tim.
ESG, I don't know. Is that going to affect it? I don't know. But yeah, I'm pretty sure people want some way to get up high buildings somehow.
Well, ESG, how would that affect the fact that there's a lot of steel and stuff goes into it? I mean, who knows?
Regenerative braking needs to be put in to compromise people's safety, but we can use that energy on the lifts going.
Right. So it's kind of like a Tesla accelerator,
Yes.
Generating energy when you put your foot down. Yeah.
And we just compromise people's safety a little bit, just to get that little bit of energy. I could see that, so it's fairly safe, and, coming into an uncertain, fiscal and environment, these are things that obviously everyone's trying to clamber into these things at the moment. But but I think, there's still room. Just hopefully I'll get a chance to jump in here.
Yeah, no, I like it. It's one of those ones on my watch list, and I've been pretty lazy over New Year. I haven't been watching much, and I just sort of notice all these retail stocks. Like, what have I missed? Have I missed it already? Have I missed it? Everybody's over it. No, don't worry about it. Yeah, earnings are going to come down this year. It doesn't matter. We're looking through, Tim. We're looking through. I mean, I was looking because US mortgage rate was down. Is down. 30-year mortgage is down to 6.1% now. It was up over 7 at one point. So markets are betting, things. But they've been doing that for all sort of last year and got it wrong. And so I just need to get it wrong for a few more months and throw the towel in, and the S&P gets to 3,200, and then there we go. Off we go.
Yeah. Oh,
that's a good one. Good one. Yeah. Was that so? That was it. Is that all we got this week? Yep. No,
try to keep it simple.
Sweet. Yeah, we're pretty simple people. That's what we do here. We keep it simple. If you like what we do, give us a follow. Don't be shy. Click that follow button. Subscribe on YouTube, and we will see you next time.